Imagine you are running a massive global enterprise. You're sitting at the center of a Fortune 500 company. It's late June. The end of the second quarter is just looming over your head, and the pressure to close out the books is immense.
Oh, absolutely. The tension in those final weeks is always high.
Right. But suddenly, your chief information officer bursts into your office, and the look on their face tells you the meticulously planned Q2 budget is about to be thrown completely out the window.
Yeah, the classic late quarter fire drill.
Exactly. They've just gotten off the phone with their procurement leads, and the whispers have turned into a full-blown roar. There are these credible, industry-wide rumors of severe hardware price hikes and immediate supply chain constraints hitting the market right now. Not next quarter, but today.
Which is terrifying when you're managing billions in capital.
Right. So what do? You scramble. You realize you have to secure servers, storage arrays, memory modules. I mean, the literal physical metal that your company runs on immediately, even if it means you have to pump the brakes and delay those massive multi-million-dollar software renewals you were just about to sign off on.
You freeze the software budget to stockpile the hardware?
Exactly. You tell your board, look, the software code isn't going to vanish into thin air by July. But the silicon might.
It is the ultimate corporate triage on a balance sheet. You are watching highly sophisticated capital allocation strategies just devolve into an instinctual grab for physical resources.
It's wild. And this isn't just an isolated headache for one particular company, right?
Yeah.
It completely upends the forecasted earnings of the vendors who were relying on those massive software contracts crossing the finish line before the midnight bell on June 30th.
Oh, it throws everything into chaos.
And that boardroom scramble, that incredibly specific dynamic in the final weeks of June, well, that is the gravitational center of today's deep dive here on Talk Tickers. Because our mission today is to unpack a document that, at first glance, might just look like another stack of dry corporate disclosures.
But it's really not.
No, not at all. We have our hands on the newly released Q2 2026 earnings call transcript from IBM, featuring their CEO, Arvind, Krishna, and CFO, Jim Cavanaugh. And as always on Talk Tickers, we are looking past the flashing red headline of an earnings miss to understand the tectonic shifts happening beneath the surface in enterprise technology right now.
Because an earnings call transcript, especially this one, when you really know how to read the negative space between the financial metrics, it isn't just Wall Street jargon. This specific document reads like a real-time stress test of global tech infrastructure in 2026.
It really does. It's a roadmap.
Yeah, a roadmap that covers the panic buying of servers, the strategic shift toward AI orchestration, all the way to a literal billion-dollar commitment to a quantum computing foundry. I mean, IBM is arguably the only vendor positioned to tell this story comprehensively.
Because they have their hands in every single layer of the stack, right?
Exactly. They maintain the legacy infrastructure the global economy rests on. They build the modern cloud software overlay. They deploy the consulting armies to implement it all. And they are funding the theoretical physics to eventually replace it.
So when their quarterly results act erratically, it's like a highly sensitive seismograph picking up tremors in the broader economy, which is exactly what we want to translate for you, the listener, into actionable insights. So let's get right into the anomaly that triggered the seismograph.
Let's do it.
On paper, the headline numbers missed Wall Street's consensus. IBM's Q2 performance delivered only 1% revenue growth and 5% operating EPS growth. Now, in the hyper-growth narrative of the tech sector, a 1% top-line expansion is going to be interpreted by algorithmic traders and analysts as pure stagnation.
The alarm bells ring immediately. People panic.
Right, the stock takes a hit.
Yeah.
But as we dig into the transcript, the shortfall wasn't a result of market share erosion. I mean, it wasn't a case of a major financial institution ripping out IBM infrastructure to go with a competitor. It was entirely driven by that sudden shift in late June we just envisioned.
Yeah, clients aggressively redirected their CapEx budgets towards supply-constrained physical infrastructure ahead of those anticipated price spikes.
Which forces us to look at the mechanics of enterprise purchasing behavior, specifically the difference between demand deferral and demand destruction.
Right, and this is a crucial distinction for any investor to understand. In corporate finance, demand destruction is fatal. The customer goes out of business, they migrate to a competitor's platform, or they simply realize they no longer need the capability your product provides.
The money is just gone.
Exactly. That capital is permanently erased from your total addressable market. But demand deferral, on the other hand, is just a localized temporal distortion. The strategic intent to purchase the software remains entirely intact.
So they still want it.
They absolutely still want it. The integrism plans are still moving forward, but the liquidity required to execute the transaction is temporarily locked up elsewhere. The timeline shifts to the right, but the deal integrity holds.
Okay, I see the logic, but I have to aggressively challenge this on behalf of our listener. Because if I'm looking at this from a skeptical analyst perspective, well, demand deferral is the oldest, most convenient excuse in the enterprise sales playbook for a botched quarter.
It definitely is the go-to excuse.
Right. I mean, if your software is genuinely mission critical, a CIO doesn't push it off to buy memory chips. You find the money. You leverage a credit facility. You don't delay the central nervous system of your business. So doesn't the fact that they delayed these massive software deals suggest that IBM software is viewed as somewhat discretionary or, at least substitutable enough that it can wait?
I completely understand the skepticism, and honestly, it's the exact same pressure testing we saw from the analysts during the Q&A portion of the earnings call. But if we look at the specific empirical evidence Cavanaugh provided, it kind of dismantles the botched sales execution theory.
Okay. Hit me with the numbers.
He notes that tens of large deals slipped in those final 2 weeks of June. But the critical data point, and Arvind Krishna really hammers this in, is that roughly 1/3 of those slipped deals had already closed in the first 3 weeks of Q3.
Wow. 1/3 of them closed within 21 days of the quarter rolling over.
Precisely. Now think about that. If a complex 8-figure enterprise software deal legitimately falls apart because the client is second-guessing the value proposition, it takes months to rebuild the business case, run it back through procurement, get the risk and compliance committees to sign off again. It's a nightmare.
Right. Enterprise sales cycles are notoriously slow.
Exactly. So the fact that 33% of the slipped pipeline converted almost the minute the Q3 budgets unlocked on July 1st, well, that proves that the deals were fully negotiated. The ink was dry. The bottleneck was strictly the physical reality of a finite Q2 capital budget colliding with a global supply chain shock.
It really reminds me of the psychological phenomenon we see in consumer markets during a crisis. Where people just panic buy essentials, like toilet paper during the pandemic.
That is a very accurate analogy.
Right. You prioritize the scarce physical asset that you fear won't be on the shelf tomorrow, and you delay buying the digital good that is, by definition, infinitely reproducible.
Because the physical servers, the storage arrays, that is the essential raw material of the modern enterprise.
Exactly. If the supply chain constrains the flow of silicon, you can't just spin up a virtual machine if the underlying metal isn't physically racked and powered in your data center. You secure the scarce asset first, knowing the abundant digital asset, the software license, is just a bureaucratic delay, not a logistical impossibility.
And we really have to look at how that finite enterprise IT budget is actually structured to fully grasp the mechanics here. A CIO doesn't just have one massive pool of money.
Right, they have different buckets.
Yes. They have operating expenses, OpEx, for day-to-day subscriptions and services. And then they have capital expenditures, CapEx, for long-term strategic investments. The hardware panic we're talking about specifically drained the CapEx pools.
Oh. Yeah.
And that brings us to a crucial nuance in the transcript. Because this panic didn't impact all of IBM's software equally, it surgically targeted one highly lucrative but very specific architectural layer of their software business, while leaving the rest entirely untouched.
Which exposes the massive underlying shift in how IBM actually makes its money today. I mean, the transcript reveals that software is now nearly 45% of IBM's total revenue.
That's a huge shift from even a decade ago.
It really is. We're looking at a company that has fundamentally re-architected its revenue base away from pure infrastructure and legacy services and toward higher margin software. Right. And the split within that software revenue is fascinating. 80% of it is recurring.
Highly predictable.
Exactly. We are talking about consumption-based and subscription models, platforms like Red Hat, HashiCorp, and Confluent. The transcript notes this recurring revenue grew nicely, hitting an annual recurring revenue, or ARR, of $24.6 billion, up 8%.
That $24.6 billion ARR figure, that is the shock absorber for the entire company. Those are the tools modern developers rely on to orchestrate hybrid cloud environments.
So they're indispensable.
Totally. Red Hat Enterprise Linux is essentially the foundational operating system for corporate data centers today. HashiCorp automates the provisioning of that infrastructure, and Confluent manages the massive data streams flowing through it. And because these are consumed as subscriptions, they hit the client's OpEx budget.
Oh, I see.
Yeah, they are paid out like utility bills. So when the CapEx budget froze in June to hoard servers, the OpEx budget just kept paying the Red Hat subscriptions without missing a beat.
That makes total sense.
Yeah.
The monthly water bill gets paid even if you have to delay the massive home renovation project.
Exactly.
But that leaves the remaining 20% of the software portfolio. This is the transactional software, largely tied to what they call enterprise license agreements, or ELAs. And this specific tranche of transactional revenue declined 9% in the quarter. It took the entire brunt of the hardware panic.
It was the shockwave epicenter.
So let's unpack the anatomy of an ELA, because to the modern developer, someone raised on AWS and flexible SaaS models, an enterprise license agreement sounds like an archaic relic from the 1990s. Why does a modern financial institution willingly lock itself into a rigid, multi-year software contract?
Well, because for the world's most complex, highly regulated entities, extreme agility is often a secondary priority to extreme operational resilience and predictability.
Interesting. So safety over speed.
Exactly. An ELA is not just a software purchase, it is a strategic architectural commitment. When a global bank signs an ELA with IBM, they are negotiating a massive, multi-year bundle that intertwines their transaction processing capabilities, their core data management, and their automation layers directly into their mainframe infrastructure.
And crucially, it operates as a CapEx investment.
Right.
So it draws from the exact same finite pool of capital that the CIO needed to raid to buy the physical servers. The budget collision is totally clear now.
It was a direct hit to that specific capital pool.
But going back to the concept of the ELA itself, if I'm a CIO, locking myself into a 3 to 5 year inflexible contract seems incredibly risky given how fast technology is moving.
It would be risky, sure, if they were locking themselves into a narrow single-purpose application, but they're locking themselves into an ecosystem that provides what we call an incumbency mode.
An incumbency mode. Okay, break that down for me.
By structuring this as a massive ELA, the client secures unparalleled, guaranteed support SLAs, massive volume discounts, and complete financial predictability for the systems that process their most vital transactions.
So they know exactly what they're spending for the next 5 years.
Exactly. And from IBM's perspective, the ELA creates a powerful multiplier effect. Once you embed that deep into the operational DNA of a client, it becomes structurally and economically prohibitive for a competitor to rip and replace that infrastructure.
The switching costs just become astronomical. Nobody wants to be the CIO who tries to migrate the core banking system and accidentally loses 1 million transactions.
It's a career-ending move.
And those massive software ELAs don't exist in a vacuum. They're fundamentally tied to the physical metal they run on. Which brings us to perhaps the most counterintuitive and frankly fascinating data point in the entire earnings call.
I know exactly where you're going with this.
We have to talk about the mainframe. Because despite overall infrastructure revenue declining 7% in the quarter again, driven entirely by the timing of those delayed cycles, the underlying metrics for the mainframe are staggering. The newly released Z17 mainframe is currently having the best refresh cycle in reported history.
It's actually tracking at 130% compared to the previous cycle, the Z16. And the Z16 was already a record-breaking generation.
It's wild. We are looking at a computing architecture that pundits and venture capitalists confidently declared dead, 20 years ago?
Oh, at least. Every year someone says the mainframe is dead.
And yet it is currently experiencing an unprecedented renaissance. The scale of its continued dominance is hard to wrap your head around if you only follow consumer tech trends. The transcript states that over 70% of the world's transaction volume by total value runs on IBM Z.
70%. That is the vast majority of global commerce.
Yeah, and there are over 140 million installed MIPS globally, MIPS being million instructions per second. And 85% of clients are either maintaining or actively growing their mainframe capacity. I think there's a profound disconnect between the tech industry's obsession with lightweight, distributed cloud architectures and the actual engineering reality of the global financial system.
There absolutely is a massive disconnect.
Right. We are so obsessed with digital wallets and decentralized ledgers, but the bedrock of the global economy, the central banks, the massive clearinghouses, the global insurance firms, they still rely on an impenetrable, centralized, heavy-duty steel bank vault.
The bank vault analogy is highly accurate, specifically when you examine the total cost of ownership and the physics of data gravity. Jim Cavanaugh stated plainly on the call that, depending on the workload, moving off the mainframe can cost a client 2 to 15 times more.
Wait, up to 15 times more to move to the cloud?
Yes. And that isn't just marketing spin. It's a reflection of the architectural limitations of distributed cloud computing.
Okay, you have to walk me through the mechanism of that cost multiplier. If AWS or Azure provides practically infinite, supposedly cheap compute, why is it 15 times more expensive to run a credit card processing system there instead of on a centralized mainframe?
It comes down to network latency and data egress economics.
Okay, latency.
Think about it. A modern mainframe is a marvel of centralized co-location. The compute processors, the massive memory pools, and the storage arrays are physically millimeters apart, connected by proprietary, hyperfast internal channels.
So the data barely has to travel.
Right. When you swipe a credit card, the system has to check your balance, run a fraud detection algorithm against your last 5 years of purchases, authorize the vendor, and update the ledger. And it has to do this in single-digit milliseconds, perfectly, millions of times a second.
Right, because if it takes 3 seconds to process a swipe, the line at the grocery store backs up, and the global retail economy literally grinds to a halt.
Exactly. If you attempt to dismantle that centralized monolith and rewrite it as microservices distributed across a public cloud, you suddenly introduce network latency between all those different components.
Because they aren't millimeters apart anymore.
Exactly. The compute node has to send a packet across a massive data center to query a database node, wait for the response, then query the fraud node. The latency compounds with every step. Furthermore, public cloud providers charge massive fees to move data across their networks. Those are egress fees.
The hidden tax of the cloud.
Precisely. To replicate the sheer throughput and zero latency performance of a single mainframe, you have to provision an obscenely large and expensive footprint of cloud servers, and you bleed capital on networking costs. The economics simply collapse for hyperdense transaction processing.
So the sheer physics of latency and the economics of data movement form the first layer of the incumbency moat. The second layer, obviously, is security. The architecture of the IBM Z series incorporates pervasive encryption at a hardware level.
It's virtually unhackable by conventional means. But here's where the paradox gets really interesting. They haven't just left this impenetrable vault in the 1970s. The transcript reveals they are heavily investing in bringing cutting-edge AI directly inside the vault.
This is the real game changer for the Z series.
Yeah, they're deploying tools like the Spire Accelerator and Watson X Code Assistant for Z, and they noted that nearly 50% of Z17 customers are actively investing in these on-premises AI capabilities.
Which is a massive strategic pivot away from the prevailing narrative that AI requires moving all your data to the public cloud.
Right. Everyone thinks you have to upload everything to OpenAI or Anthropic.
But enterprises are sitting on decades of highly proprietary, heavily regulated data locked inside these mainframes. It is their most valuable asset. And they are terrified of extracting that data, decrypting it, and sending it over the public internet to train a generic foundational AI model in the cloud.
I mean, the compliance risks alone.
Exactly. The data sovereignty violations, the exposure to cyber threats is an absolute non-starter for a European bank or a U.S. healthcare provider. So the strategy is elegant in its simplicity. Don't move the data to the AI. Bring the AI inference engine directly to the data. By utilizing the Spire Accelerator, they are essentially embedding AI processing units directly onto the mainframe silicon.
You can run incredibly sophisticated fraud detection models or generative AI analytics directly against the live encrypted transactional data stream with zero external latency and zero exposure to the public internet.
It turns the ultimate system of record into an on-premises hyper-secure AI engine. And the correlation they highlighted is really telling. Clients who are deploying these AI tools on the mainframe are growing their overall Z capacity 3 times faster than those who aren't.
They're finding entirely new ways to monetize their legacy data because they can finally analyze it safely.
This strategy of bringing AI directly to the secure data layers perfectly illuminates IBM's broader approach to the entire generative AI revolution. Because if you look at the wider market, the narrative is completely dominated by the trillion-dollar tech giants fighting a scorched earth war over raw compute.
Yeah, the hyperscalers are spending billions on GPUs.
Exactly. They are burning cash to train the biggest, most parameter-dense foundational models that can generate hyper-realistic videos or, pass the bar exam. But IBM is playing a fundamentally different game. The transcript states their AI strategy is anchored on 3 pillars: hybrid, sovereignty, and trust.
Arvind Krishna explicitly argues that while the massive investment in foundational models is necessary for the industry, the actual enterprise value is rapidly shifting away from the models themselves and toward the orchestration and data layers.
It is the classic pick and shovel strategy during a gold rush, but elevated to enterprise architecture. They recognize that foundational models are on a trajectory toward commoditization.
Absolutely.
Whether an enterprise uses a model from OpenAI, Anthropic, Meta, or an open source variant, the raw intelligence is becoming a highly accessible utility. The true differentiator for a Fortune 500 company isn't the model. It's how securely and efficiently they can orchestrate multiple different models across their proprietary data without losing control.
And that's exactly where IBM is positioning itself.
Okay, I see the logic of the pick and shovel strategy, but I want to push back on this orchestration narrative.
Sure, go ahead.
Is it possible that IBM is leaning so heavily into terms like orchestration, neutrality, and governance simply because they were outgunned in the foundational model arms race? I mean, when you can't build the biggest, flashiest LLM, you pivot and declare that managing other people's LLMs is actually the most important job. Are they just trying to carve out a niche as the highly paid hall monitor of AI?
It's a cynical interpretation for sure, but it ignores the brutal reality of enterprise IT integration. Let's look at the actual bottleneck throttling AI adoption in the Fortune 500 right now.
Okay, what is the bottleneck?
The bottleneck is not generating a creative poem or summarizing a PDF. The real friction point is the agonizingly complex task of re-engineering entrenched business processes to incorporate digital labor safely.
Meaning actually putting the AI to work in a corporate system.
Right. A company might want a lightweight open source model to handle internal HR queries because it's cheap to run. Then they might want a highly secure proprietary model to analyze financial forecasts, and maybe a massive multimodal model for marketing generation.
Right. You don't use a Ferrari to go to the grocery store.
Yeah.
You use the right model for the right task based on cost and compute requirements.
Exactly. But how do you manage that routing? How do you ensure the HR model doesn't accidentally access the financial forecasting data? How do you maintain an audit trail of every decision that AI makes to satisfy regulators?
That sounds like a compliance nightmare.
It is, and that is what orchestration means. Platforms like Watson X Orchestrate provide the unified control plane. They allow a CIO to swap models in and out as the technology evolves, preventing vendor lock-in with a single AI provider while maintaining strict centralized governance over data access and compliance.
And that really explains why IBM Consulting is acting as the massive vanguard for this entire strategy. The transcript notes that generative AI engagements represented a staggering 50% of all consulting signings in Q2.
50% is a massive number for a consulting division of that size.
Yeah, and it now makes up over 30% of their total consulting backlog. Clients aren't just buying Watson X off the shelf and figuring it out themselves. They are hiring IBM Consulting to physically map out their chaotic internal data swamps, sanitize the data, build the guardrails, and actually deploy the digital labor.
The consulting arm is the deployment engine here. The enterprise market has largely moved past the phase of running fun, isolated AI pilot projects.
Yeah, the honeymoon phase is over.
Exactly. Boards are now demanding actual ROI and productivity gains, but deploying AI into a massive, messy corporate environment requires highly specialized technical talent, what IBM refers to in the call as forward-deployed engineers.
Forward-deployed engineers.
Yeah, these are the mechanics who know how to integrate a modern LLM via API into a 30-year-old inventory management system without breaking the entire supply chain.
And as these AI deployments scale across global enterprises, they drastically expand the attack surface, which transitions us perfectly into one of the most specific, high-stakes revelations in this earnings call.
The Mythos vulnerability.
Yes. In early April 2026, the industry was rocked by a massive security vulnerability known as Mythos. The transcript specifically calls out how this event dramatically accelerated the discovery of open-source flaws for their clients. Now, for the audience deeply embedded in software engineering, the fragility of open-source dependencies is a known nightmare.
It keeps security teams up at night.
But the scale of Mythos seemed to break through all the way to the C-suite.
To understand the systemic risk Mythos exposed, we really have to look at modern software supply chains. The vast majority of enterprise applications are not written from scratch. They are assembled using open source packages.
Pre-written blocks of code.
Right, blocks of code maintained by decentralized communities of volunteers that handle fundamental tasks like encryption protocols, networking, or data parsing. It is highly efficient, but it creates deep, often invisible dependency trees.
If we use a physical infrastructure analogy, it's like discovering that the underground water pipe system for a major metropolitan city built layer upon layer over 50 years has critical junctions made of highly toxic lead.
That's a great way to visualize it.
Mythos was the realization that this lead piping is everywhere, buried deep underneath the most critical financial and governmental applications on the planet. And manually finding every single compromised package, testing a fix, and replacing it without shutting off the water supply to the city is an insurmountable manual task.
The manual remediation process is agonizingly slow. I mean, a human developer has to parse the dependency tree, isolate the vulnerable package, write a patch, run exhaustive regression testing to ensure the patch doesn't break dependent systems, and then carefully deploy it.
That's just for one instance.
Exactly. When you are dealing with tens of thousands of instances across a global bank, the manual approach leaves the window of vulnerability open for months. Hackers know this, and they exploit that window aggressively.
This is where IBM's response, a capability called Lightwell, fundamentally shifts the paradigm of software maintenance. Extending the plumbing analogy, Lightwell is the equivalent of deploying a fleet of autonomous, AI-driven plumbing robots.
I love that image.
Right. They can swim through the entire municipal water system, instantly detect the specific molecular signature of the lead pipes, automatically fabricate a perfect copper replacement, test the pressure tolerances in real time, and hot swap the pipes without ever dropping the water pressure for the end consumer.
And the market adoption metrics for Lightwell validate just how desperate enterprises are for this capability. Jim Cavanaugh explicitly listed the early adopters on the call.
Yeah, I have the list here. Bank of America, BNY, Citi, Goldman Sachs, JP Morgan Chase, MasterCard, Morgan Stanley, Royal Bank of Canada, State Street, Visa, Wells Fargo.
That is the literal central nervous system of global capitalism.
It is. And they are paying million-dollar yearly subscriptions for this service. Why? Because the transcript notes that in just the first 2 weeks of availability, IBM made over 7,500 remediated open-source package versions available to these clients.
We are seeing the true power of applied AI automation here. Arvind Krishna explains the mechanism on the call. They essentially built an AI factory.
An AI factory to fix code.
Right. They utilized specialized large language models fine-tuned on code architecture to automatically parse the vulnerable open source repositories via abstract syntax trees.
So it's looking at the fundamental structure of the code.
Exactly. The AI writes the remediation patch, automatically generates the unit tests to validate the fix, runs the regression suites, and packages the safe version. And the most critical detail here is that the AI is doing this for open source packages where IBM does not have direct human expertise.
Which is incredible. My read on this is that it's a masterstroke of leveraging their Red Hat incumbency. Red Hat is already the trusted authority for securing enterprise open source. By bolting an AI automation factory on top of it, they've created a highly lucrative, infinitely scalable insurance policy against the next mythos.
They are turning the chaos of open source vulnerabilities into a highly predictable, recurring revenue stream.
Exactly. They're commoditizing the remediation of technical debt. It's brilliant.
It really is.
But while they're using AI to relentlessly patch the software at the present, the transcript reveals they are also throwing billions of dollars at the hardware that will completely redefine the future. I want to shift our focus to the back half of this earnings call, where the conversation pivoted from quarterly guidance and software margins to the literal frontiers of theoretical physics.
This is where it gets really sci-fi.
Right, because Arvind Krishna stated unequivocally, and I quote, "Quantum computing is no longer decades away. It is upon us, and we are investing aggressively." And the numbers back up the rhetoric. IBM announced a staggering $10 billion investment in quantum computing over the next 5 years.
A $10 billion capital commitment is a definitive signal that quantum has exited the exploratory R&D phase and entered the commercialization phase.
And it's not just a solo venture. They announced a massive public-private partnership with the U.S. Department of Commerce. By leveraging $1 billion in JAIC Act incentives, matched by $1 billion cash contribution from IBM, they are breaking ground on Andron, which is billed as the world's first pure-play quantum foundry.
The terminology here is really critical.
Yeah, explain the foundry concept.
So a foundry in the semiconductor industry is a massive, highly automated manufacturing plant capable of printing silicon wafers at extreme scale with incredibly low defect rates. By building a quantum foundry, IBM is declaring they have solved the fundamental engineering challenges of equipment design and are now focused on the industrial scale manufacturing and packaging of quantum hardware.
So they aren't just tinkering in a lab anymore.
No, it is the leap from handcrafting intricate mechanical watches to establishing a fully automated assembly line.
And they provided a highly specific, highly aggressive timeline tied to this manufacturing scale-up. They detailed their roadmap to a system called Starling, targeted for deployment in 2029. They describe Starling as the world's first large-scale, fault-tolerant quantum computer.
Fault tolerance is the key phrase there.
Let's dig into the mechanism of fault tolerance here, because it is the absolute holy grail of quantum mechanics. We know that qubits operate on the principles of superposition and entanglement, allowing them to process vast, multidimensional probability spaces exponentially faster than a classical supercomputer.
Right, the computing power is theoretically mind-blowing.
But the fundamental flaw has always been their extreme fragility.
The fragility is the core engineering bottleneck. Qubits are highly susceptible to environmental noise. A microscopic fluctuation in temperature, ambient electromagnetic radiation, or even a stray cosmic ray can cause a qubit to undergo decoherence.
Decoherence, meaning it loses its quantum state.
Exactly. It loses its state and injects a fatal error into the calculation. Up until this point, the industry has been trapped in the IceQ era noisy intermediate-scale quantum computing. We can build small arrays of physical qubits, but they are so noisy that they cannot reliably execute the deep, complex algorithms required for enterprise use cases.
Things like molecular simulation or cryptographic factoring.
Right, they just fall apart before the calculation finishes.
So how does Starling achieve this fault tolerance by 2029? How do you overcome the fundamental physics of decoherence?
You overcome it through a concept called quantum error correction, specifically utilizing surface codes. The mechanism involves grouping hundreds or even thousands of noisy physical qubits together on the processor to act collectively as a single, highly stable, logical qubit.
Okay, so you are essentially using massive redundancy to mask the physical noise.
Precisely. The system constantly measures the syndrome of the physical qubits, detecting errors as they happen, and dynamically corrects them in real time, faster than the errors can cascade and destroy the calculation.
That sounds incredibly complex to manage.
It is, but achieving large-scale fault tolerance means Starling will have enough stable logical qubits to execute algorithms with millions of gates without a single uncorrected error. It is the moment quantum computing transitions from a fascinating laboratory experiment to a dependable, commercially viable computational engine.
And the fact that major analyst firms like IDC currently rank IBM first overall in quantum ecosystem readiness lends immense credibility to that 2029 target. It is genuinely thrilling to see theoretical physics operationalized at this scale.
It's history in the making.
But if we pull the lens back to the immediate reality of a publicly traded company, building a multi-billion-dollar quantum foundry and funding massive AI automation factories requires immense sustained capital. And they are doing this in a quarter where they just reported a top-line revenue miss due to supply chain hardware panic.
Which normally would terrify investors.
Right. Wall Street is notoriously myopic. They demand profitability today, not quantum supremacy in 2029. So how do they square that circle?
Which brings us to the final and perhaps most impressive technical achievement detailed in this transcript.
Right.
The financial engineering and operational discipline managed by the CFO, Jim Cavanaugh.
Let's parse the guidance he delivered. The transcript shows that IBM lowered its full year 2026 revenue guidance. They had previously projected 5% or higher growth, and they pulled that expectation down to a more conservative range of 4 to 5%. Now, in almost any other context, lowering annual top-line guidance is a massive red flag that triggers a massive sell-off. But the stock didn't crater. Why? Because in the exact same breath, Cavanaugh adamantly maintained their commitment to grow free cash flow by $1 billion for the year, and he explicitly noted they expect to expand their adjusted EBITDA and operating pre-tax margins.
That combination of metrics lowering revenue guidance while maintaining cash flow growth and expanding margins is a masterclass in demonstrating operating leverage to institutional investors.
Operating leverage. Walk us through how he's signaling that.
By setting the low end of the revenue guidance at 4% and calling it an anchor, Cavanaugh is heavily telegraphing his risk management strategy. He is openly building a financial model based on a pessimistic, worst-case macroeconomic scenario.
So he's assuming the worst.
Exactly. He's assuming the Q2 hardware buying panic persists, that the global supply chain remains tight, and that software ELAs continue to face delayed sales cycles.
He is bracing for impact, basically telling the street, look, even if the macro environment remains hostile and we only hit 4% revenue growth, our underlying profitability engine is so highly tuned that we will still drop more cash to the bottom line than we did last year.
That is operating leverage in action.
But where exactly is that leverage coming from? How do you squeeze more profit out of less revenue?
It is driven by ruthless, systemic, internal productivity actions. Over the last 4 years, IBM has completely re-engineered its internal cost structure. The transcript details that they have grown free cash flow by $6.5 billion and expanded margins by 700 basis points over that period.
That's massive. Did they just do massive layoffs?
No, they didn't do that through massive layoffs. They did it through structural automation. They are accelerating the reduction of third-party spend. They are optimizing their real estate footprint. And most importantly, they are aggressively deploying their own AI technology internally.
Oh, they're drinking their own champagne.
Exactly. They are using Watson X to automate their own HR and financial operations. They're using AI to optimize their own chaotic global supply chain logistics. And they're using tools like Watson X Code Assistant to dramatically increase the productivity of their own internal software engineering teams.
So they are their own best case study.
Yes. Cavanaugh explicitly stated that these internal AI-driven productivity actions are exceeding expectations and will yield roughly 100 basis points of margin expansion for the full year. That internal efficiency more than offsets the revenue headwinds caused by the delayed software ELAs.
It fundamentally proves the company is not bloated. They have built structural shock absorbers deep into their balance sheet. They have the financial discipline to absorb a sudden macroeconomic shock, whether a quarterly revenue miss, continue paying out a massive $3.2 billion annual dividend to their shareholders, and still aggressively fund a $10 billion quantum computing foundry without taking on toxic debt.
It really is a masterclass in managing a transitional enterprise during turbulent times. It requires an incredibly steady hand at the executive level to balance the immediate demands of quarterly capitalism with the decade-long time horizons required for deep tech innovation.
Yeah, as we step back and view this earnings call transcript in its totality, the sheer breadth of the narrative is astonishing. I mean, we started by dissecting the frantic late June boardroom panic as CIOs froze their CapEx budgets to hoard physical servers, triggering a wave of demand deferral for enterprise software.
Right, and then we explored the 80-20 software split, revealing how the $24.6 billion ARR fortress of OpEx subscriptions, Red Hat, HashiCorp, Confluent, insulated them from the shock.
Then we unpacked the deep paradox of the Z17 mainframe, that impenetrable 50-year-old architectural vault that processes 70% of the global economy, which is now growing 3 times faster because they're embedding zero-latency AI inference directly onto the silicon.
We analyzed their highly pragmatic AI orchestration strategy, sidestepping the foundational model compute wars to focus on the highly lucrative business of governing, securing, and deploying digital labor via IBM Consulting.
And we look at the terrifying systemic reality of open source vulnerabilities exposed by Mythos, and how Lightwell's AI factory is automatically parsing abstract syntax trees to hot swap the digital plumbing of global finance.
And finally, we trace the roadmap to 2029, exploring the mechanics of logical qubits and surface codes that will enable the Starling system to achieve large-scale fault tolerance, all funded by an internally automated, highly leveraged balance sheet.
It is a massive amount of strategic insight pulled from a single hour of corporate disclosures. But before we sign off, I want to leave you, the listener, with one final, deeply provocative thought that stems directly from the collision of these different business units.
Okay, lay it on us.
Think about the dual reality of IBM's architecture right now. On one side of the house, their absolute bedrock of the financial engine, generating massive incumbency and operational leverage, is the Z-series mainframe. Its entire value proposition, the reason clients tolerate the massive 15x cost multiplier to stay on the platform, is its impenetrable hardware-level encryption. It is the ultimate protector of the legacy global economy.
It is the cryptographic vault.
Yes, but on the exact opposite side of the house, this same company is pouring $10 billion into building the Andorran quantum foundry. They are racing with hyper-aggression toward the Starling system in 2029. But if you understand the physics of a large-scale, fault-tolerant quantum computer, you know that it is theoretically powerful enough to run Shor's algorithm at scale.
Oh, I see where you're going.
It has the computational power to instantly shatter the standard RSA encryption protocols that protect almost every digital system on Earth today.
Including, potentially, the legacy cryptographic protocols that secure those very same mainframes.
Yes. It sets up a cosmic-scale innovator's dilemma. If IBM successfully executes their quantum roadmap and achieves fault tolerance by 2029, will they simultaneously invent the exact weapon capable of breaking the vault that keeps their legacy business secure?
That is a fascinating paradox.
Will the quantum technology of 2029 render the physical hardware panic of 2026 entirely obsolete? They are attempting the ultimate high-wire act, ruthlessly protecting and monetizing the infrastructure of the past, while actively, aggressively funding the exact theoretical physics that has the power to destroy it. Will they be able to upgrade the entire global financial system to quantum-safe encryption before their own quantum foundries come online?
The race is happening right now inside the exact same company.
And based on this transcript, they are heavily funding both sides of it. So for you, the investor, keep questioning the underlying mechanics of the headlines, keep looking past the top-line numbers, and we will see you on the next deep dive.